Welcome to Hotel Property Finance. I'm Georgina, and this is the show where we explain how money actually flows into UK hotels, in plain English, for owners, operators and investors. Today, we are setting the scene for 2026, how hotels get funded, what the numbers look like right now, and what the market is telling us. Let's start with the backdrop. The Bank of England base rate is 3.75%, held since the cut in December 2025. That matters because hotel debt is almost always priced as a margin over base rate, so a steady base rate gives everyone a firmer anchor for planning. On the trading side, the picture is reasonably healthy. STR and CoStar put UK hotel occupancy at around 76% through 2025, and houses like JLL, Savills, CBRE and Knight Frank all describe a market where lending appetite is improving and there is a lot of capital waiting to be put to work. JLL in particular points to strengthening debt markets and record dry powder driving hotel investment this year. Now here is the single most important idea in hotel finance. A hotel is not just a building. It is a trading business that happens to sit inside a building, and lenders fund both together. So when a lender looks at a hotel, they are not only asking what the bricks and mortar are worth, they are asking how much sustainable cash the business generates. The headline trading metric is RevPAR, revenue per available room, which blends how full the hotel is with how much each room earns. The profitability measure is EBITDA, often adjusted for a management charge and a reserve for furniture and equipment. And the valuation is usually done on a going concern basis by a chartered surveyor, reflecting the income the operation produces rather than an empty building. That trading focus shapes every funding route, so let's walk through the main ones. First, acquisition finance, for buying a hotel. Senior term debt for a stabilised, well-trading hotel currently sits broadly between 6.5% and 8.5% all in, on terms that can run from 10 to 25 years. Loan to value is typically around 55 to 70% on a going concern basis. Branded freehold hotels with experienced operators sit at the stronger end. Independents, leasehold and first-time operators sit at the more cautious end. Second, development and refurbishment finance, for building or substantially upgrading a hotel. Here lenders size against cost and against gross development value, usually around 60 to 65% of each, with mezzanine able to stretch the total higher. Mezzanine sits behind the senior lender and is priced higher, often around 11 to 18% a year because it carries more risk. Third, bridging finance, for speed-led and transitional situations. Auctions, chain breaks, fast purchases, or carrying a repositioning project towards stabilisation. Bridging is short-term, commonly priced around 0.85 to 1.25% a month, on terms up to roughly 12 to 18 months, and it almost always needs a clear exit, usually a refinance onto term debt or a sale. Fourth, refinance and equity release, which is dominating the market right now. As older facilities mature, owners are refinancing onto new terms, and many are releasing equity from improved trading to reinvest or expand. Lenders test affordability through debt service cover, often looking for something like 1.4 to 1.75 times. And then there is portfolio finance for groups with several hotels, where a single facility can sit across multiple assets, and owner-operator versus investor structures, including the OpCo-PropCo split that separates the property company from the trading company. We have a dedicated guide for each of these. So what is actually happening out there? The market in 2026 is refinancing-led and selective rather than frothy. We have seen very large refinancings of landmark London hotels running into the hundreds of millions, group-level refinancings backing established collections, and specialist lenders funding new branded budget and lifestyle hotels in cities like London, Manchester and Edinburgh. At the other end, there is genuine distress too, including a West End hotel brought to market in a sale guided above £275 million and the occasional stalled scheme. That spread, Strong assets refinancing comfortably while weaker ones change hands is exactly what you expect at this point in the cycle. If you want the detail, we have built a full set of guides covering hotel acquisition finance, development and refurbishment finance, refinance and equity release, owner-operator and investor structures, distressed and turnaround funding, hotel bridging, and group and portfolio finance. You can find them linked from this episode and at hotelpropertyfinance.co.uk. One important note before we finish. Everything in this episode is general market commentary, not advice and not a quote or an offer. The figures are indicative bands for UK trading hotels, and real terms are always set case by case by individual lenders. Commercial hotel lending is unregulated business lending, so do take professional advice for your own situation. That's our 2026 overview. I'm Georgina. This has been Hotel Property Finance, and we'll see you in the next episode.